When the missiles are flying, you should be buying is a famous quote by Cashin. Let's dissect whether this is the case in the market and what I expect to come from this. Last week, we received alarming news that Israel has reportedly launched a significant military strike on Iran's Russian nuclear facility. According to some reports, the entire Iranian general staff, including the head of the military, was killed in this strike. This is clearly a major geopolitical escalation and a manifestation of the rising tensions that had been building up throughout the week. Last week, Israeli messaging following the attack indicates that this is just the beginning, and they are signaling that their operation against Iran will likely last at least 2 weeks. In response, Iran's supreme leader has vowed that Israel will face severe punishment and also warned that both Israel and the United States will pay a heavy price. I will not go into the details of this and the geopolitical consequences right now, but I think that Trump will likely do everything in his power to de-escalate the situation as quickly as possible. We know from his prior behavior that he's extremely sensitive to rising oil prices, and he said on Friday actually that he does not like the recent increase. Trump is also under increased pressure to push the Federal Reserve, especially Jerome Powell, to cut interest rates and bring back quantitative easing. A rise in oil prices could disrupt that plan, and here's how. Well, higher oil prices lead to an increased supply and transportation costs. Airline and freight costs also go up. This filters through PPI and CPI, adding inflationary pressures. Energy and transportation are key components of the CPI, and if container shipping costs go up, we might also see higher prices on goods. This is especially relevant given the ongoing concerns about whether tariffs might eventually show up in the CPI data. So far, we have not seen a major impact, but we cannot rule this out. If inflation rises, the Fed may have to take more hawkish stance, which would push bond yields higher and apply more pressure on the already slowing US economy. Trump will be determined to avoid this scenario, and it's likely that he will do everything he can to bring the situation under control. At the start of the video, I told you and quoted Cashin, when the missiles are flying, you should be buying. Historically, large-scale military events often lead to buying opportunities once the initial fear subsides. This may prove true again, while other risks still linger, like the unresolved trade and tariff deals. History suggests that if markets sell off sharply in response to this attack, it could ultimately present a good opportunity to buy. This makes psychological sense too. Since April, the S&P 500 has rallied over 20%, but it's been one of the most disliked rallies in recent history. Well, and this is because many investors have stayed underexposed. Hedge fund positioning remained light because early in the rally, price action did not match fundamentals. Later on in the rally, valuation concerns stopped investors from chasing price action. So if we get a notable dip now, those who missed out the May pump may jump in aggressively, seeing it as a second chance to catch up. In that context, any sharp pullback could be a midterm opportunity to re-enter quality names. Even before this geopolitical shock, many asset classes were setting up moves higher. The oil already had bullish signals, skew was increasing, positioning was strong, and it was also breaking above key EMAs. Gold also surged on the news, but accumulation was already evident during the recent choppy price action. A return to all-time highs was looking increasingly likely. In terms of equities, the market was already at a major supply zone, as we've been saying throughout the videos. A pullback or at least some consolidation was expected around here. So while the trigger, the military strike, was unexpected. The market reaction itself was not out of line with what we've been expecting. Overnight, volume was light, so futures movements should be taken with caution. The current pullback came right into the 21-day EMA, retested the uptrend line and previous breakout zone, exactly where we might expect to bounce. And yes, the market did bounce from that expected zone. Bitcoin, a couple of words for it. It did a similar reaction, bouncing off the technical support. VIX spiked initially, but is coming down in the calmed down actually on Friday. The market was heavily skewed towards short volatility. Delta was very strong in the money. Traders had been shorting VIX. The news triggered a volatility short squeeze. So anyway, what's the trading plan? Right now, you need to pay attention to the key supports and resistance levels for the S&P. Friday's price action is harder to predict due to low volumes, but here are the most important technicals. The 21-day EMA, this is your first line of defense. If it holds, that's a bullish signal. If the 21-day EMA breaks, the next level to watch is the 5,900 level. This is where the market might exaggerate and start selling off a bit more aggressively. If this level breaks, 5,800 is the next level where we likely find a buy the dip opportunity. A deeper pullback could bring us back to 57.50. This is the worst case scenario, and we test the 57.50 and 57.20 range. But right now, I do not consider this likely. So yes, the event was unexpected and tragic, but from a market dynamic standpoint, it has not disrupted the broader setup going into June's options expiration. We were already seeing bullish setups in oil and gold, market hitting resistance and was due for a pullback, overly bearish volatility positioning for a reversal, and unless we see a major change in the market structure, this pullback will likely be viewed as a buying opportunity, especially for investors who missed the bulk of this rally and are now eager to re-enter on any dip. That's basically it for now. See you next week. Like and subscribe if you've enjoyed today's content. Thank you and see you next week.